Today's show is sponsored by CloudZero. For software-driven companies focused on growing margins, CloudZero is the only cloud cost intelligence platform that puts engineering in control by connecting technical decisions to business results. By analyzing cloud services like AWS and Snowflake, CloudZero provides real-time cost insights that help you maximize margins. Engineering teams can answer critical questions like, who are my most expensive customers? How much does this specific feature cost our business? What's the cost impact of re-architecting this application? With cost anomaly alerts via Slack, product-specific data views, and granular engineering context that makes it easy to investigate any cost, CloudZero is your complete cloud cost intelligence platform, connecting the dots between high-level trends and individual line items. Join companies like Drift, Rapid7, and SeatGeek by visiting cloudzero.com/cloudcast to get started today. That's cloudzero.com/cloudcast.
Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are, and welcome back to the Cloudcast. We're coming to you live from our massive Cloudcast studios here in Raleigh, North Carolina. And as I hit record on this, we just recently celebrated Father's Day. So happy Father's Day to everyone out there, all the fathers. Hope you had a good Sunday. And it's a very slow news week this week, actually. So I'm going to jump right into the first article. And for our first article, we actually have, this one is a bit of a throwback. Does anyone remember the Capital One hack through AWS back in 2019? Basically, unsecure S3 buckets, and it was actually an AWS employee. An engineer at the time wrote a tool that would basically walk the S3 buckets and looked for unsecured private information. And because of that, Social Security numbers, birth dates, and the like for over 100 million people in the US and Canada was released. And Capital One saw a bunch of fines and did a bunch of settlements. But this, of course, this person responsible for it, this has come to trial. There has been a conviction. And Paige Thompson faces up to 20 years in prison. For our second article, Reddit is actually buying machine learning platform Spell. And what was interesting to me about this was how Reddit actually is using machine learning. So how they're using it today was the personal recommendations and the Discover tab as well, which the app introduced earlier this year. Those are all machine learning based in the background. And as part of this acquisition, they're going to be transferring some of the technology as well as a lot of the engineers as well. The is an undisclosed amount, and they are actually closing down their commercial product as well in the midst of this acquisition. So it'll be interesting to see the improvements that comes to Reddit based off of this acquisition. And for our third and final article, this one is all about Internet Explorer. Internet Explorer is gone for good. It has taken a long, long time. And there's a good article over at Ars Technica about it, about the history of it. It was the browser everyone loved to hate, but it is officially now dead and buried and no longer receiving updates. And of course, everyone has moved on to other browsers. And if you're in the Microsoft world, it's Microsoft Edge these days, of course. But I thought it was interesting to see how long it actually takes, something that is a tool that has millions and millions and millions of downloads to actually get cycled out in our industry. With that, we're going to wrap up Cloud News of the Week. Coming up right after the break, we have Kent Bennett over at Bessemer Venture Capital talking about the state of cloud for 2022.
If you're a software engineer, you've been there. You're finally relaxing after a long day and you get paged. Something's broken. Are the servers down? Is the database slow? Is there a bug in the latest deployment? Now the whole team is panicked, going from tool to tool and person to person to troubleshoot the problem. That won't happen if you get New Relic. New Relic brings together 16 monitoring tools so teams can see across the entire stack from one place. More importantly, with New Relic, you can pinpoint problems down to the line of code to fix problems more quickly. That's why more than 14,000 companies, including DoorDash, GitHub, and Epic Games, use New Relic to debug and improve their software. The next late night call is just waiting to happen. Get New Relic before it does. You can get the whole New Relic platform and 100 gigs of data free forever. No credit card required. Just visit newrelic.com/cloudcast. That's newrelic.com/cloudcast.
And we're back. And, folks, it is getting to the middle of the year, kind of getting to the midpoint of the year. And one of the things we always like to do, and we'll do a couple of times in the next few shows, is kind of, figure out where we are in the year. A lot of things change. A lot of things change from year to year, from quarter to quarter. And, sometimes we'll do some recap shows, and sometimes it's good to have some outside perspective on what's going on. And one of the things that we often point out, whether it's in Cloud News of the Week or in other places, is people who do some really good research and have some really broad perspective on what's going on today. And so we're going to dig into the Bessemer Venture Partners 2022 State of the Cloud. And to help us do that today, really excited to have Kent Bennett, who is one of the VCs at Bessemer. Kent, welcome to the show. Great to have you on.
Hey, Brian. Thanks. Excited to be here.
I want to talk about the report. I want to dig into it, but give us a little bit of your background. You've covered a lot of different areas, and really, what's your focus today at Bessemer?
Yeah, so I think I've been at Bessemer 14 years, so I'm like a teenager. Still can't drive a car, but have definitely made a lot of mistakes. I wandered in those 14 years through a bunch of different sectors, spent some time in much deeper technology, software, storage, the like. And then in my late toddler years, mucked around in the consumer world a whole lot. But there was exposed to, what many of the rest of my partners were up to in the SaaS world, where I started to look at consumer-facing vertical SaaS companies. And so now I spend most of my life in what I guess you would call vertical SaaS, although as that model has evolved, it starts to look less vertical at times, more, like B2B industrial stuff,
Okay.
Some marketplace activity. But, all things SaaS, especially vertical SaaS, are where I spend most of my time.
Yeah. And how would you define vertical SaaS for folks that maybe don't think in those terms?
Yeah, totally. Vertical simply meaning software that is specific to some industry. So restaurant software for dentists.
Gotcha.
I invested recently in a company that does software for dry cleaners and laundromats.
Okay.
So it can get really niche and really specific, but there's a ton of power in that focus.
Yeah. We've always noticed that SaaS amongst all the industries has just, thousands and thousands of people that, go after those specific things for businesses. So very, very cool. Mm-hmm. These days, the media headlines around cloud are sort of a mixed bag, right? On one end, you've got, your 3 or 4 big cloud providers who are still announcing 30%, 40%, 50% growth on, large valuations. And then we've, unfortunately see, this company's laying off some people. These people are having to have a down round and so forth. If I'm picking up the 2020 State of Cloud, and we'll have a link in the show notes for folks, what are the headlines coming out of that? What are you guys seeing things? What's the perspective you're seeing out of this State of Cloud?
Yeah, well, look, it was a mess this year. For the last 10 years, we've been able to basically say, like, cloud's pretty good. And this year, I'll give you some behind the scenes dish. We don't do this live. So we started writing the script in January, February, and the markets, certainly the public markets, were down 30, 40, 50%.
Right.
And so everyone was very aware of that. But at the same time, as we checked in with our cloud portfolio companies, for the most part, nothing had changed. The businesses themselves were doing really well. And so we sort of pulled a lot of our hair out thinking, like, do we want to say the cloud is still good because we're going to look like we're not reading the room? Or do we want to acknowledge that something has changed in a meaningful way? And of course it had, even if it was simply the sort of perception of the value of the cloud, that change mattered. And so we kind of went with 2 headlines, which is it's the best of times, it's the worst of times.
Yeah.
And not trying to be too cute or have it both ways, but we think it is important to acknowledge that as valuations have crashed in a pretty spectacular way, that's about perception, but all of a sudden it becomes reality because, and we can go into a lot of detail, but every cloud founder or CEO knows now that it's going to be 4 times as expensive for them to raise more money.
Right.
And that means, the marginal investment decision you were making as a founder now doesn't look quite as good. And even worse than that, there's now this, I would say, somewhat superficial desire on the side of outside investors to see profitability in a cloud business. And the reason I say that's superficial is because, and we can go into more detail, but I think the cloud is the greatest business model in the history of the planet because it's a business model where many, many businesses have proven their ability to convert $1 of investment into $1 of revenue, a few months later,
right.
And $1 of revenue that is sticky and often grows itself. So it's the greatest business model in the history of the planet. And to arbitrarily say that business model should be profitable that's just too basic of a read. But that is the narrative right now. And therefore, there's this recursive thing that happens, which is smart founders are saying, well, I should be profitable because if I want to raise more money and I'm not profitable, I'm going to have some, explaining to do. And they're appropriately adjusting, and that's going to lead to layoffs, and that's going to lead to hiring freezes, and that's going to lead to, tricky financings for those who got unlucky to get caught out in the cloud. So it's a complex story. But then on the other hand, these businesses are still great. And, I think we may see some macro trends that slow down some of these businesses depending on which industries they're exposed to. But these products, in so many cases, are delivering some undeniable feature improvement over some existing alternative, while at the same time being really affordable, sometimes free. And so, that business model is going to work for a long time.
Right. Right. Yeah. And it's a challenging thing because, like you said, on one end, you don't necessarily want to be Chicken Little. You also don't want to be all unicorns and rainbows, and it's somewhere in between. And the reality is, there are plenty of times, and for any of us who've been around this industry for a while, where you see, bad businesses, and I don't mean bad in the sense of like illegal or bad people, just
right.
They're not run very well, that are able to coast along for a while. And then you see in other times when we have shifts in the industry, especially if they're, sort of negative shifts or downshifts, where, you find the best managers, the best allocators, the most creativity happens in some of these challenging times. And you start figuring out, how well do you know your market? How well do you know your customers? How well are you able to adapt? And so,
totally.
I think like you said, the right way to go about it was, to a certain extent to say, hey, look, let's be honest with each other. Like things have changed. But at the same time, in a lot of cases, the fundamentals of what some of these technologies deliver are still as valuable as they were in March or February or whatever. And they may end up being even more so, if we get into, some different situations. So yeah, totally. I appreciate, kind of that perspective and just the realities that, it's not kind of
no, and the narrative will be very sucked up by the very visible explosions, like the companies that just go down in flames. That I think I would agree with your assessment. Most of those, there will be some companies kind of tragically caught terrible timing, sure. But most of those were never all that viable as companies, from a fundamental level. From what we see, but in times like the last 2 or 3 years, you didn't need to be a great company to attract a great financing always. So, and some of the great companies did. But then there are a lot of them that probably wouldn't have been financed in 2009 were. I don't necessarily think like better or worse businesses are formed at times like these. I think it's just that the only thing that ever really mattered, which is having a radically better product than some existing alternative offered at a great value proposition, now really, really matters. Right, and right. So at times like these, you just get a bunch of the weeds, cut back.
Yeah. We've obviously seen some pretty interesting amounts of money over the last few years, right? There was, obviously a lot of stimulus came out of what happened with COVID and money flew into places, and obviously you're in the business of helping to properly allocate to allocate capital in good ways. People want it to be allocated. We saw some good valuations. We saw some crazy valuations. Give us a sense for those of us that don't live in your world all the time. Like, what have the inflows look like over the last couple of years? What have the outflows look like? And like, what's sort of the scoreboard look like in terms of, are we still seeing VCs raising big funds, or are you slowing down? Like, guidance you're given to your companies, those types of things.
Yeah, I think the big picture is, record amounts of capital flowed into venture firms and out of venture firms into startups in the past few years, and last year was the all-time record year. And I would bet my life that this year will be much lower on the funds deployed from VC funds, and almost certainly lower on the funds raised by VCs. And I think that is, as I think about government stimulus and what that drove, I certainly low interest rates maybe were part of that acceleration of that story at the end, because low interest rates led to higher multiples, which led to, bigger eyes thinking about this asset class. And probably drove some of that activity at the very end. But I think for the most part, it was a 10-year march to, from a risky posture in 2009, 2010, and then seeing in many cases continued goodness of the SaaS model, which I think is a huge part of that story. There was, certainly some consumer mobile stuff that was very shiny and cool, and real businesses there built, of course. But, the vast majority of the number of the businesses were great SaaS businesses. And so that just drove investors to continue to put risk on for a decade. And but it has come off in a pretty hard way. That being said, there was $100 billion of venture capital raised last year. It wasn't all deployed in January before things got really chilly. And these VC funds have pulled back meaningfully on their pace, in part because maybe there's been some top-down discussion that we should pull back. But, speaking from our firm, it's just that not a lot of great entrepreneurs are out raising money right now, because there's, again, this recursive cycle of they know it looks silly to be raising money right now. Yeah. And so, I think pace will be well off this year. Valuations will come down, and that has the effect of when, if last year you could have raised at a $500 million valuation, it was easier to justify raising $100 billion. If today you're raising at a $200 billion valuation, you don't necessarily want to raise $100 billion, therefore selling a third of your business, right? So I think that the sort of valuations coming down has a bit of a ratchet squeeze effect that will shrink the dollars deployed. And so my guess is there will be a bunch of, venture capital dollars that will be sort of sitting on the sidelines, but some of it will be itching to jump back in.
Sure.
But there'll be some tension at which valuations, which entrepreneurs will need to raise, all that kind of stuff will play out.
Yeah. I want to dive into the report a little bit. One of the things, and you mentioned this, previously, like, a lot of the report will focus on SaaS as the delivery model for these technologies. And it really highlights a kind of an important thing. And I think this sort of backs up your statement that, this is sort of the best delivery model that we've delivered, sort of business model that we've seen. It talks about the idea that $1 of investment, $1 of capital for sort of the best SaaS companies turns into $18 of revenue in a reasonable amount of time. Can you walk us through a little bit of how you get from that level of investment to say the $18 investment, but there's also a really good chart that sort of shows on average it turns into say $7 or $8. Like, how do I get from 1 to 18? But also, like, what's the thing that differentiates the $7 or $8 kind of multiple to the $18 multiple?
Yeah, well, and part of that is timing of when we hit print on this report. Not a lie, because private valuations have maybe crashed a bit since then. But I think this is the thing: is we were writing this report that we all stepped back because we are fish swimming in water as people who live and breathe the SaaS model, and I think we take for granted, what a miraculous business model that it is, but if you look at the top, 100 public, SaaS companies that we track, and across the board, you see businesses that have what we would describe as a 12-month or better payback, meaning they spend $1 on a sales or marketing professional, and the dollar that is spent, or the $100,000 spent on a salary, If you look at the end of the year at the sort of business that those professionals have brought in, it tends to be $1 or greater of business. And that's in a software contract that in many cases grows itself. So, if you sell software to someone who owns 10 restaurants, they might buy software for 3 of the restaurants, and then slowly they're going to roll it out to the other 10 over the next several years if your software is great. And so many of the businesses see this, what we call the net negative churn dynamic in SaaS. So $1 turns into $1 of revenue. And in the public markets today, that $1 of revenue trades at anywhere from 5 to 15 times recurring revenue, sometimes even a little higher, depending on the growth and the efficiency of that business. And so you have a business model that can take $1, turning it into $1 of high margin revenue in a year. Actually, a cash on cash payback would be, 100% return in many cases of just cash going in and out of the business. But then in terms of the trade-off for enterprise value, it's a 4 to 10x return in 1 year. And these businesses can do that all day long. They can hire, in many cases, as many sales people as they can possibly hire to scale up that golden goose. And that's just a business miracle. And we see it happen so much, and we put all this nomenclature around it that we sort of like forget that it's pretty incredible, and that, frankly, you just don't find many equivalent businesses that can do that in consumer or in many other areas of tech even, and much less, energy sector where you might get a 20% annual return, right?
Right. Yeah, and I think that, having worked in sort of both sides of the sector in both sort of software and SaaS, I think that's probably the piece that if you don't sort of really dive into how SaaS works and the stickiness of it, and to a certain extent, just the, how long it takes to get from, like the cost of acquisition and all this, but like, if you don't really understand the subscription model, the stickiness of that model, it is sort of hard to understand just, how powerful it becomes and how dependent people become in being able to say, look, I don't have to do those things. I can offload it to this service. I can offload to that service. It provides tremendous value. I can start thinking about other stuff. It's a pretty powerful thing that, unless you live it and really study it, it is sometimes difficult to understand.
Totally. Yeah. Totally. And I'll occasionally talk to, it's not really my world, but talk to public markets investors. And, these are really smart people who, are much smarter than me at many, 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 many things. But then they'll ask the question like, can these SaaS companies make money?
Yeah.
And you realize like, oh, what's happened is these SaaS companies, when they're private, because they have access to the world's greatest golden goose, they feed it as much as they can. I mean, right. And so like from a pure math value, as a SaaS entrepreneur, if you are well capitalized, if you have the balance sheet, the money in the bank to support it, you're insane not to burn as much as you can rationally at the margin, right? To invest in sales. But then, public markets investors who don't live and breathe this model look at your history and they say, gosh, this business has always been unprofitable. And I can look down the street at the candy store that's profitable. And so why hasn't this business been profitable? And what we're saying is, well, trust us, we could be profitable tomorrow if you wanted us to, but we would just be missing a massive investment opportunity. And today they're all saying, yeah, please do that. Actually turn to profitability. So if you look at the top 10 market cap public SaaS companies today, they are running an average free cash flow margin of something like 20%. Now that's not the case of some of the emerging ones, some of the ones that have just gotten out of being private, because again, they're in this like, gosh, why wouldn't I invest mode? But my bet would be that as the public markets demand it, you will see more and more public SaaS companies run, positive free cash flow in the next year or 2 or 3, because they all can. Yeah. They simply have to slow down their sales and marketing investment.
Yeah, you'll see them slow. Yeah, exactly. They'll slow down how much they market. It'll slow down some of their growth, but once they have those customers, they become very, very profitable customers. I want to talk about. There's another concept within the report, and to anybody listening, there are, I would say, a dozen really interesting concepts. We won't get to all of them in this, but I highly recommend you dig into it. There's a concept in there I thought was really interesting. You guys call it first act, and it talks about indirect model. So in essence, it's it's this concept that if I'm a business, if I'm a business owner, there are a million things that I need in order to run my business, from sales and marketing to HR to all these different things I need. And I have an option. I can hire people. I could hire skilled people, but the SaaS market has sort of filled in, and I see this every day in the company that I work at now. That's a smaller startup company. Like, there is a company for everything that you think of, every task on your to-do list. And I'm curious, how you guys think about that, because on some end, it's awesome that there are people who are like really expert at all these different tasks, and then there's a certain part of me that goes, there is an overhead to sort of keeping track of all of them, and at some point, like, will we see, it in certain functional areas like consolidation? But how do you,
Yes.
like, help me kind of think through, how much specialization should there be for these companies, and how big can they get, versus will there be people that come along a la what Oracle did back in the old days, where they said, I'm just going to, kind of bring together a whole bunch of these things. Where do you see the market in that concept?
Yeah, I mean, it will be a mess, and it's not going to be one answer. But
Yeah.
I think there's a couple really interesting ideas embedded in the question. One is this idea of, and you see it, really vertical SaaS, industry SaaS has been on the cutting edge of this, where these software products are in many cases the core operating system that runs the business. So if you're a restaurant, you've got a point of sale software system, but it also manages your kitchen and many other things. And it's your heart lung machine.
Right.
And that system is directly adjacent to many pieces of legacy functionality that are essentially a commodity. An example would be your credit card payment system. Another example would be your payroll service. So payroll, apologies to that industry, but that's pretty commoditized space.
Sure.
And so these pieces of software actually contain all the information you need to run your payments and to run your payroll, because they have all the merchant information you need. They have all the information about all the employees. And so all of a sudden they can take over those legacy services that frankly were milking a pretty big margin from these businesses, offering them a commoditized service. And what that means is all of a sudden your piece of software can also become a payments company and a payroll company and a lending company and a bank and a debit system and an insurance provider, and do all of these things, often using third-party platforms that have APIs that make it very easy for them to do those things without having to do the deep work of becoming, doing all the work of becoming a payroll company themselves, as an example. And so all of a sudden, the software is making, as much or more margin on these adjacent services as it is on the core software. And that is value that they can, pump back into customer service and product development and sales and support and all that. And so that bundling movement is a huge part of the SaaS story right now. It started in the verticals. I think there are many opportunities in just sort of enterprise software. Again, the software needs to make sense, and it needs to touch an adjacent piece of monetizable service that makes sense. It's not going to, if you had an HR piece of software, it's not going to all of a sudden become your credit default swap system. I mean,
Right.
it's got to make sense, right? But maybe it becomes your background check system, and it monetizes that service that you were paying somebody else for, formally. So that's a big part of this. And then the second question you asked is just in general, what will be bundled and what would be standalone features? And there, I think, absolutely, we will see a bunch of bundling consolidation, again, where it makes sense. And I think the thing to look for is if you have a piece of software that is, delivering a feature or two, and there are multiple players that do the same thing, and there are big software players nearby in the ecosystem, watch out, because those software players are going to think about buying one of your competitors or you, and offering it as part of a bundle, possibly with a pricing discount, possibly giving something away for free. And so we're seeing that in many spaces. At the same time, there's all these new needs that are being tackled by software that are way too immature to be at that commoditized and prone to be bundled stage. There's another trend too, which is a lot of this software, is sold direct one-to-one, but we're seeing a lot of services pop up in the middle and act as sort of marketplaces where maybe you don't need all your software to come from one core original provider, if you can buy it all in one place and manage the contract in one place and even get some pricing transparency in a market of sorts, maybe that makes your life easy enough that you don't need to bundle and you can manage the best of breed approach that many companies take today.
Yeah. No, that's a topic we could probably cover for
yeah. Sorry, I went long. There's a lot.
It's great. I think it's just an area that if folks are either working in SaaS or a lot of the people that you work with, like essentially your colleagues become SaaS companies to definitely keep an eye on. I want to ask you one last question, and again, we could cover a whole ton of different things. I want to be conscious of time. There's another section in the report that talks about kind of the impact of this, kind of the great resignation that we've seen over the last couple of years, and to a certain extent we're still experiencing. It's impacted tech workers, it's impacted non-tech workers. How do you guys, what did you see in this space? How do you see technology playing a role, whether it's positive or negative? And what sort of guidance maybe do you see in the market, or do you give to the market around, what's happening with this great resignation and what may evolve from it?
Yeah, I mean, I think it is. There's a couple obvious places where software is playing a big role. One is in some ways powering the great resignation, right? Because software is creating opportunities for individual entrepreneurial minded people to go into business for themselves, whether that's, doing some online service that they can provide with the platform, starting to sell something online through Shopify as an example, finding flexible work on, either in person through some of the software and other tech products or online. So, it's a lot easier to leave your job today than it was years ago, because you have a lot of alternatives and many of those are software powered. And then at the same time, software is going to power a lot of the productivity at those businesses who are desperate to hire good people. And when they can't, they may modify the way that they're running their process to take advantage of software coordination so they can do more with less labor. And we're going to see plenty of that for sure. And then in the sort of knowledge work world, you're obviously seeing a massive moment of transition to this remote and hybrid culture. And we're still figuring out what that, even means, like what is the office of the future?
Right.
But I think it's pretty clear that it's that some version of salaried work is going to go to more fractional and flexible work, and that's probably appropriate for both sides in many cases. So I think it's like all of these things, it's a bunch of different things happening all at once. But I think software is at the middle of all of them, and will continue to play a pretty big role.
Yeah, no, good stuff. One last question, and we didn't get through the whole report. I wish we had more time. Any other sort of insight or concept in there that like, just kind of people wouldn't necessarily expect, or really kind of surprised you as you were doing the research and analysis?
The big takeaway for us, the big sort of moment that made us smile a little bit, was to think about the unicorn bubble and the unicorn frenzy that sort of led us to this moment,
right? And
reflect on like how far we'd come and in a sense where we went wrong. And so 10 years ago, Aileen Lee wrote this really thoughtful, actually, blog piece on unicorns, which were then 40 very special private companies in the world that were worth more than $1 billion. And it was 40 companies. I think 3 or 4 had been minted every year. Well, last year we had 500 new companies become new unicorns. And, the tech world is actually more active. There's more stuff happening for sure than 10 years ago, but not 100 times more stuff.
Right.
That sort of what happened was a lot of people read Aileen's piece and thought this is really interesting and cool. But unfortunately, a takeaway that many people had was, I want to be a unicorn, like not like what's different about these special companies, but I just want to be one. And so there was this huge bubbly race to be named a unicorn. And it got very detached from the fundamentals of the business. 10 years ago, to be a unicorn as a SaaS company, you basically had to have $100 million of revenue, because SaaS companies 10 years ago were trading at 10 times recurring revenue, maybe a little less, maybe a little more, but it was in that ballpark. In the last year, we saw companies with $3, $4, $5 million of revenue earn that $1 billion valuation. By the way, some of them may grow into it over time, and it may work out, but But that distortion, is a big part of this picture. So what we've done internally is reset ourselves to track the companies that are the $100 million of recurring revenue SaaS companies. We're calling them the centaurs, which my partners Mary D'Onofrio and Adam Fisher came up with that term because the centaur is I think the defender of the helpless unicorn in a lot of mythology. But then Byron Dieter also pointed out with really cheesy dad joke energy that cent R is cent and ARR. Either way, 100 million revenue companies are sort of for us the new measure of the health of the cloud economy. And we sort of thought about this and we created a big database. And then frankly, we held our breath because we didn't know what it was going to say. We were a little bit worried it was going to say that like 2 or 3 years ago, we had peaked and there were no more, and we were slowing down in the pace of creation of new 100 million revenue companies. But thankfully, that's not the case. Last year was the biggest year on record at creating new 100 million ARR companies. And this year we're on pace to create even more. And again, we may see some moderation if we have a big recession that really forces these businesses to pull back on the gas a little bit. But I don't think they're going to shrink. And my bet would be that we see as many, if not more, centaurs created this year as last year. And that's a stat we'll continue to track in the years ahead, because that's going to tell us, at some point the SaaS economy will mature, and we will see a slowing of the pace of new massive up and coming SaaS companies, but we haven't seen it yet. That's the good news.
Yeah, no, that's good. I like that approach. Again, I think, anytime we go through big changes like this, the guidance we've always given to people, and we've done this show for a while, is, at some point you get back to fundamentals, and the fundamentals, like in what you're talking about, is really, measuring companies in ways that we used to measure them when you felt good about them, you felt stable about them, you felt like they were going to sustain. I like that approach. I think it's very rational. Like you said, we'll see where it goes and how much it grows. But Kent, this has been great. Like I said, I wish we had a ton of time to cover everything in the report. Folks, as you know, we'll put it in the show notes. Definitely go take a look at it. One of the things I really like about it is you guys come at it from a lot of different perspectives. It's, what you see in the market. Obviously, you're on the side of, having invested money, but you're working closely with your customers. You get to hear what their customers are saying. So it's not just purely sort of survey stuff. There's a lot of bigger picture things in there, as well as some really good data. So I highly recommend it. Kent, thanks so much for the time. This has been really interesting. It's been good to get your perspective on things, and we love to always make sure we have a good connection with the VC community to help us, kind of follow the money and where investments are going. So
yeah, really appreciate it, Brian. Thanks,
folks. With that, I'm going to wrap it up. On behalf of Aaron and I, we want to thank Kent for his time, for his insight. As always, thanks for helping us grow the show. Thanks for telling a friend and helping us grow the community. And with that, we're going to wrap it up, and we will talk to you next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.